Okay, now let's look at Euro USD and a couple of case studies that started from the 14th of October up until the 15th of October. As you can see, there is 3 potential pretty decent trades. Now, if you look to the left, there's a bank level on the 1 hour time frame that you can't really see. It's quite hidden since you need to go to the smaller time frames. Again, there is no bank levels here. There is also no bank levels here and no bank levels here. However, if you go down to the smaller time frame, starting from the minimum 15-minute, you can then immediately identify some of the bank levels. So some of the rules of the bank level trading strategy is that if you see a confluence, such as this particular boomerang / compression, but you don't see a bank level on the 1 hour time frame or on the 4 hour time frame, you may have to go to the 15-minute to look for it. Once you look for it, then you can identify it. Sometimes if it's not even here, then you go to the 5-minute. If it's not on the 5-minute and it's not in confluence with your boomerang, then you need to go to the smaller time frame, even the 1 minute, even sometimes a 30-second time frame. As long as the bank level is in confluence with your boomerang setup, then it's valid. But let's look at the 15-minute now. So from this particular entry, we can see that there was obviously 1, 2, and the third tap fake out. Simple boomerang, right? Simple stuff. But look at the nature of the compression. Now, in this particular boomerang, there wasn't much of a fake out, but the compression or the wedge was a lot thicker. It wasn't as compressing as this. There's a big difference. If you look at the difference between the compression, you've got a really tight compression. These are higher probability trades. Then you've got this compression here. Number one is a descending compression, so you need to be buying the market. Number 2 is an ascending compression, so you need to be selling the market. The only difference is that this one is a lot tighter. The tighter the compression, the bigger the breakout. Look how tight this compression was and look how big the breakout was towards the next step profit at the bank level. This was a risk reward of a 5.6 AR, whereas this one was a 4R. So there's a big difference. Now, let me just remove these drawings from the left and let's focus on the next relevant potential boomerang and bank level entry. So again, the same principle. There's a 1, 2, 3, and on the third tap, there is, as you can see, look, 1, 2, 3, third tap, boomerang to the left to where? A bank level. Let's zoom into the bank level now, just to give you guys a clearer picture. Let's just update this pattern. And what can we see? Very clear bank level. Momentum to the upside. Didn't even retest after first candle, second candle, third candle, fourth candle, and finally it tried to retest. Once it went long again, this bank level becomes valid and it failed to retest multiple times. And eventually it did go to it on the boomerang, the 1, 2, and 3, and finally it went up towards the upside, towards the next imbalance / bank level. And again, similar scenario to this particular entry here to the left. Price broke down with momentum, pulled back, failed to retest. So we know that this bank level was valid. And then what do we see? 1, 2, and the third tap boomerang. Whereas, to be fair, this is more of a third tap wedge pattern. And this is a pattern that I personally wouldn't take myself. The reason I wouldn't take this particular entry up here is because it's not part of my rules. My rules suggest that if there's a 1, if there's a 2, the bank level needs to be up here. And as you can see, there was no bank levels here. So I'm just giving you an example. This is actually a trade that I wouldn't have taken. The other 2 are fine because there's a fake out of the boomerang. There's a fake out of the pattern. So this is a boomerang, right? So these are completely valid. Now, let's actually zoom out and just see what else is actually happening. So we're kind of stuck within a range. We're capitalizing in 3 trades in the space of 1 day. We've got 5.6 AR. Then there's a potential 4.13R and then 3.4R. So that's the equivalent of approximately 7.5. Add this is around, let me see, 8, 9, 10, 11, 12, around 13R on average in the space of 1 day, a 13R, one market. This is why You don't need to be trading 30 markets all at once. One market is enough. Now, just to redefine what I mean about the size of the compression and the breakout, if you notice the width and the distance between this particular wedge pattern and the boomerang, look how it broke to the upside, formed a wick, and completely reversed. It's because the wedge and the boomerang was quite thick. Whereas here to the left is really, 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 really tight, and it completely just eventually made a new high. So it makes a big difference knowing what sort of boomerang you want to be taking. But this is something that you need to also be backtesting on all your currency pairs. Every single boomerang, every single pattern is going to be tailored to you. So you might notice that there's a 1 tap here, a 2 tap here, and then maybe a 3 tap. When it's really close to each other, I know because I've backtested that on the 3rd tap fake out, normally this trade fails. So you need a healthy gap between them that's really, really consistent. You can see here, look, the gaps are quite consistent. Look, the width between that and this level and this level and this level is very consistent. When it's something like this, for example, and you see a distance between the wedges and it's 1, 2, and then 3, these are really invalid. Okay, now let's look at some examples of the imbalances on the Euro USD. So starting from the left, what can we see? We can see that price failed to retest the imbalance and the bank level. I do believe it retested the bank level, maybe to the pip, but we are backtesting currently how the imbalances are working. If we zoom into this particular entry on the imbalance, entry would have been at the 50% fib, stop loss just above the imbalance, right? TP on this example, let's just do previous structure. Okay, decent little 8.2R, but let's actually break down what exactly the imbalance is showing us. So first of all, this is a valid bank level, right? Valid bank level, broke momentum, and it failed to retest. And that failed retest is causing the imbalance. So we're placing the Fibonacci from this point to this point, and we're implementing a 50% range. This is the imbalance. Yes, on this occasion, the bank level did play out perfectly, but we're just giving you an example of how to trade the imbalance. So entry would have been at the 50%, stop loss just above the actual imbalance, and this is exactly where your trade would have been. Pretty decent trade, cannot complain about that. So let's look at another example. There's an imbalance here of the 50%, small tiny imbalance, stop loss just below the Fibonacci indicator if you want to be aggressive, but I would definitely suggest you backtest because every market is different. Or if you want to be conservative, below structure. We're just going through the aggressive approach. TP at the previous structure, which is here, 7R. So we've got 7R, 8R, and there's another trade here. Again, we're looking at the imbalance, entry at the 50%, as you can see. Stop loss just below the indicator, and TP right where structure is at. And this is actually the live market. Now, this almost missed the bank level, as you can see, which would have been here. Oh, this one actually would have hit your entry. However, what you don't want to do with bank levels is you enter it here, but then you're meant to put your stop loss below this structure or conservatively the previous structure. This is why with the imbalances is a little bit more effective. But again, we do want to see a pattern in conjunction with the imbalance. And as you can see, there is a pattern here on the 15-minute. So this is a perfect imbalance entry. Really, really good risk reward. TP previous structure. Obviously, once you do your top-down analysis, you'll have a larger TP, such as the outer structure of this pattern. And we'll be looking at potentially a bank level just above there. Maybe there we go. There's a potential bank level here to the left. Let's actually draw down all the bank levels or imbalances. Just have an imbalance as a conservative target with this particular range right there. Go back to the current market. And this is a good area to be taking profit. This would be where you take 20% of your positions off. Previous structure, take 80% away. but the long-term target's 20% away from there. It's still a 17.67R trade. Now, these trades do come often, but you need to distinguish which one is valid, which one is high probability, which one you should avoid. Now, the first scenario, right? The first scenario is pretty decent because I can see a pattern and is in confluence with the imbalance, right? Which is fine. Okay, that's complete. Now, with this particular entry, is there a pattern approaching it? Not really. If we zoom in one more time on the second scenario, there is no imbalance. However, this particular imbalance, the entry would have been inside of the pattern, and we don't want to trade that. We don't want to trade inside of the pattern. So this, for me, would have been an invalid trade. This would have been valid just about because it's just outside of the pattern and it's above structure. Here, it's not really below structure. As you can see, what I mean by structure is this, right? So we're aiming for a stop hunt. Here now, a stop hunt will be here. So this imbalance is very, very low probability, even though, yes, it did play out. As you can see, if we look at this particular area, this is a good trade because what do we see? We see it's below structure. There's equal lows there, right? With these equal lows, not only do we have equal lows, but we've got some compression and we've got the imbalance with a nice tight entry. So by now you would have put your trade on break even, at least, or be banking some of the positions at TP1, which is the nearest bank level. Right here, everything else has been filled. So TP1, we can just bank here, 6.7R. And the remaining, just leave it running, 20% running at 17.6. There's actually a live trade right now. I'm not personally in it, but I'm just showing you guys an example of spotting the imbalances and identifying which one is valid and why. Now, if we want to look for a live imbalance with you guys, the way to identify it is, okay, it's broken structure on a smaller time frame. There is bullish momentum. Let's delete this for now. We delete this now. Do I see any imbalances? No. What makes it valid is we need some form of a rally, then we need a rejection and a pullback. Once it pulls back, it means it's going to leave an imbalance there, right? Between this current high and then wherever the next imbalance is. So let's just say price does this, it rallies up, then it pulls back, and this would have been our entry. So this is how you identify it, right? Entry can be here on the imbalance on the 50%, and your stop loss can be just below, right? So that's if you want to be aggressive, right? If you want to be conservative, you just put it below there. Still a pretty healthy target for an intraday position, 3R. To be aggressive, just have your stop loss here. Obviously include the spread of 1 pip above here and 1 pip below there, etc. Still a 3 pip entry. So in terms of this particular setup, there is no imbalances yet. Even the bank level that we can see here is not valid until we get some form of a missed rejection. Even just one bullish candlestick. At the moment, there's only one bearish candlestick. If we get one rejection up, then we know this is a valid imbalance and a valid bank level. Another potential scenario, but before we move forward, let's just assume that this is a valid imbalance. There we go, we're forming some form of a wick. Just one more candlestick that doesn't retest it will form it as valid. Entry can be here, pretty decent trade, which is fine. This trade here, we look to the left, imbalance, stop loss below the actual fib. Again, to be aggressive, if you want that really aggressive high risk reward, I will suggest you start with your stop losses below structure around here, then gradually backtest and see how often the aggressive one works. And it does actually work quite often. It does have a 50% win rate, more or less, every now and again, especially with the risk reward, which is fantastic. But if you're trading it Monday to Friday, the win rate is going to dramatically decrease. This is why I always trade on Friday at a very specific time at between 1 p.m. and 6 p.m. So that's a game plan. Now, in terms of another potential schematic for an imbalance, let's actually look for them. There's one here, it's an imbalance there, and there is also an imbalance approximately right there. Now, which one do we take? Again, we need some form of a pattern. If we update this pattern, which is already complete, we can then update it to something more relevant. Right, then we can see that, oh, hold on a minute, there could potentially be a boomerang right there. So if this doesn't play out and it just continues to go short, this could be your point of action. Entry, stop loss below the fib indicator where your imbalances are at. And this one trade alone, 14R. And you'll hit this within 1 day if you catch it right. And again, I will definitely advise to start small in terms of conservativeness. Once you see that it's working for yourself, then yes, be aggressive and put it below the fib because the strategy does work. So this is how you can spot imbalances in the future, in the present, and forecast them in advance. The beauty with the imbalances and the bank levels is that it's also tailored to any trader type. So for example, if you're a swing trader and you don't have time to execute trades on a 15-minute or the 1 hour time frame, you can still implement the same thing, you see? So for example, with this imbalance on the 4 hour, as you can see, to the right, there we go, imbalance from there. Entry can be at the 50% fib, stop loss below the actual imbalance range, and your TP, you guessed it, at structure, TP2 next structure, but really we want to aim for the next relevant bank level here to the left. You can still catch really, really good risk reward trades, even though you're trading the 4 hour time frame. That's if you're trading with a really tight stop loss. Now, yes, you're not confident or you still need to backtest it. I definitely suggest you put your stop loss below structure first, just to see how you get on, backtest your win rate. Then you can implement the actual imbalance entry from this particular area, and your stop loss can be below this imbalance range. And already a 10R trade in the space of just literally 1 day on the 4 hour chart, that's pretty decent if you're a swing trader and you're working full time. You can still maximize really, really good risk reward in terms of your percentage returns. Now let's look at some sell scenarios with the imbalances. So we just identified this potential entry, pretty decent 10R trade on the 4 hour chart if you're a swing trader. Take profit as the next bank level, or potentially just where this current banker block is, right? So you can have a banker block exit. Same reason as to how you can enter this particular trade. So notice how with the imbalance, you would have been triggered on this particular entry on the 4 hour chart, right? This would have been your entry. Stop loss, obviously just above the imbalance. TP, previous structure here to the left, which is pretty decent. Okay, 3R trade, not too bad. Now, if we look at where the bank level's at, this bank level, you would have missed a trade. As you can see, your entry would have been here. Stop loss above structure would have been a good trade, but you would have completely missed it, as you can see here to the left. So with the imbalances, you're averaging the range of all the liquidity, all the unfilled liquidity. So this is an example of how you can catch trades that you normally miss if you're trading bank levels. Same way that we've got a potential entry here. At the moment, this is not a valid trade for now. It is valid once price obviously approaches that level. So let's just remove this. This imbalance was complete, so was this, and so was this. So if we're looking for a potential short, this will be the entry and this will be the stop loss up here. Up here, stop loss just above the Fibonacci. And obviously with the exit, we still don't really know yet. We need previous structure. So we need something like this for it to be valid. Once it does go valid and price comes up here, then this could be the next potential exit since it's the previous structure. But again, we need confluences. So if there is a boomerang here, then yes, this imbalance will be a high probability, because if there's no boomerang, it's very likely that price will rally to the upside. So we need a pattern here. So these are just examples of imbalances for sales when you can miss potential entries and catch them using the imbalance.